Hello and welcome to another quick guide. In this guide I'm going to talk about basic variance analysis. I'm going to do sales variances, I'm going to do the cost variances. But let's just start by looking at this. This is a standard cost card that has been made by a company, and the card, they've decided that to make this unit, this widget, it's going to take 3 kilograms of materials at £5 per kilogram, a total of £15. Labour is going to take 4 hours of labour at £8 per hour, a total of £32. The variable overheads they've estimated at 4 hours at £2 per hour, giving a total of £8 per unit. And the fixed overheads, so clearly they're using absorption costing, and they are absorbing the fixed overheads at 4 hours per unit at £3 per hour, giving a total of £67 per unit. That's the cost of each unit. And this is the budget for the next period, let's just say next month. They plan to sell each unit at £80 per unit. They plan to sell 4,500 units, and they plan to produce 5,000 units. There was no opening stock, but there will clearly, based on this, there will be closing stock of 500 units. And at the end of the period, here we can see the actual results. So the sales were 4,750 units, which sold for a total of £374,500. They produced 5,300 units, and the production costs were materials. They used 16,050 kilograms of material at a cost of £82,658. With labour, they paid for 20,750 hours of labour. Actual worked hours were 20,100, leaving 650 hours idle time, and that cost £167,100. The variable overheads came in at 41,500, and the fixed overheads came in at 64,800. So before we go on to make a budget table in the spreadsheet, let's just remind ourselves of what we've got here. So the production budget originally was for 5,000 units. Actually during the period 5,300 units were produced. The sales budget was 4,500 units, and the actual sales was 4,750, an extra 250 units sold, and the closing inventory was budgeted to be 500 units, and because production made a little bit more, even though a little bit more was sold, the closing inventory is 550 units. So let's start by filling in the table with the original budget. From the original budget information, you can see the plan for sales was 4,500 units at £80 per unit. So let's put that in, and there we can see that 4,500 units budgeted sales at £80 per unit gives sales revenue of £360,000. And let's carry on doing the materials and labour and the other production costs. From this table you can see that the budgeted production was 5,000 units, so we'll start with 5,000 units. So I've put in the 5,000 units, and from the cost card we can see that materials cost come to £15 per unit, and so I put that into the table and we'll get the total cost for materials as per the original budget, and that comes to £75,000. So if I go back to the cost card and put the information in for labour, this is the standard cost card, and labour is £32 per unit, so I'll put that in now at 5,000 units. So there with labour we can see that it's 5,000 units at £32 per unit gives £160,000 budgeted for labour. And from the standard cost card we can see that variable overheads are budgeted at £8 per unit, so 5,000 units times £8, I'll put that in, and there we can see 5,000 units at £8 gives variable overheads budgeted cost of £40,000 for the period. And finally the fixed overheads, clearly this is an absorption costing system. The fixed overheads, 4 hours at £3 per hour gives £12 per unit, and there were 5,000 units budgeted to be produced, so I'll put that into the table. And here we can see that the fixed overheads came to a budgeted figure of £60,000, and this gives a total production cost of £335,000. Now we need to look at closing inventory. Well, we can see that budgeted sales were 4,500 units and budgeted production was 5,000 units, so there's a difference of 500 units, and those 500 units will be closing stock or closing inventory, and closing stock is valued at standard cost, which the standard cost we can see from the cost card is £67, and so closing inventory is 500 units times £67, which gives £33,500, and this allows us to find the figure for cost of goods sold, which is total production cost minus closing inventory, and that figure comes to £301,500. Based on these figures we will see a budgeted profit of £360,000 minus the cost of goods sold £301,500, giving us a budgeted profit of £58,500. So if everything went to plan, the budgeted profit would be £58,500. So let's put some actual results in. Now the information for the actual results is from the information card. So let's start by looking at the information card for sales. So here's the information card, and it points out that actual sales were 4,750 units, and they sold for £374,500. So I've simply copied the values over. In the notes column I put the number of units that were actually sold, and I put the value of the sales, what they actually sold for, in the actual results column. So essentially I'm simply going to copy over the information from the information card. Looking at materials, we can see that 16,050 kilograms of materials were used, and to buy these materials cost £82,658. And so I've simply put in the cost of the materials. And from the labour information row I can see that it cost £167,100, so I'm going to just copy the numbers directly into the table, 167,100, and there it is, labour 167,100, and variable overheads came in at 41,500, and so I typed that number in, and fixed overheads came in at 64,800, and I simply put the numbers in. So these represent actual results. Adding up the production costs, we get a total production cost of 356,058. And when it comes to closing inventory, we can see that there were 550 units of closing inventory from the actual results. So we put in 550 units times the standard cost, which is 67 per unit. And so I've entered the 550 units times £67 per unit, which gives a value of closing inventory of £36,850, and that gives a value of the cost of goods sold or the cost of sales of £319,208. So we'll work out the actual profit now, and there we can see the actual profit of £55,292. So if we look at the information that we've got so far, we can see that we've got the original budget here, and we've got the actual results here. but it's almost impossible to make a comparison between the original budget and the actual results because, well, quite simply, the original budget we budgeted to make sales of 4,500 units and the actual sales were 4,750 units. Now how do you compare that? And also down here we've got 5,000 units in the original budget for closing stock, and we've actually got 550 units in closing stock. So the way that we solve the problem of making a comparison is by flexing the budget. So by flexing the budget, we take the original, actual, or the budgeted costs, either the budgeted sales or the budgeted production costs, and we use actual figures, actual units, to give us an indication of what we should have expected based on the budgeted figures. So, for example, with sales, we expected to sell 4,500 units at £80, but we actually sold 4,750 units. Now, if we had sold those units at £80, what would we have expected to receive in sales revenue? We actually sold 4,750 units, and at the standard cost of £80 per unit, standard selling price, we should have expected £380,000 of sales revenue. Now you can make a comparison because we actually received 374,500 in sales revenue. And if we wanted to look at the variance now, the difference, what we actually got in sales revenue was this figure, 374,500, and what, based on the flexed, the original standard costing and the flexed budget, we should have expected to get £380,000. So the difference is 5,500. As it happens, it's a negative figure, but that doesn't necessarily mean that it's adverse or favourable. More profit is favourable, less profit is adverse. So in comparison to the flex budget, we received 5,500 less than we would have expected, and that is what makes the variance adverse. And notice that's the total variance. So now we move on to the production costs and the material costs, and what we do is take the actual number of units produced and multiply it by the standard cost per unit, which is £15. So from this card, in terms of production, the original budget was 5,000. The actual results, we produced 5,300 units. And so the cost that we would expect to incur are 5,300 units at £15 per unit, which is £79,500. This is the figure that we would have expected to spend on materials by making 5,300 units. And if we look at the variance, well, we can actually see that we spent £82,658 on materials. So why was that? Let's work out the variance. That's what we expected. We actually paid more. It'll give a negative figure. Again, a negative figure doesn't indicate adverse or favourable. You have to look at what you expected to spend and what you actually spent. And here, in the costs, if you spend more on costs, it's obviously that gives less profit, and therefore it's an adverse variance. So to speed things up a little bit, I've completed the labour costs, the variable overhead costs and the fixed overhead costs. Looking at labour, 5,300 units at £32 per unit gives 169,600. Variable overheads, fixed overheads are charged. We'll talk about that later. And for the closing stock, 550 at £67 gives a cost of goods sold for the flexed budget. Now this is what we would have expected the cost of goods sold to be, and we would have expected this profit 61,750, but we actually got 55,292. So why is that? Now, is this an adverse variance or is it a favourable variance? Well, if you think about it, the flex budget, we expected revenue of 380,000 and we actually got 374,000, which is less than we expected. I know this is a negative figure, that's just the way that it's come out on the spreadsheet. It is an adverse variance. Now, for materials, well, we already did that, but we expected in the flex budget to spend 79,500 based on the costings, and we actually spent 82,658. We spent more, so again, that is adverse. Let's have a look at this one. We expected with labour to spend 169,600. We actually spent 167,100, which was less than the flexed budget, so that is favourable. And so let's look at variable overheads. The flexed budget, we expected to spend 42,400. We actually spent 41,500, which is less than expected, therefore it's favourable. Finally, for fixed overheads, we expected to spend, based on these levels of production, 63,600. We actually spent 64,800, an extra 1,200, and so that is an adverse variance. And notice that these variances are total variances, and what we're going to do is analyze each of these variances in turn to see how they can explain that the profit wasn't 61,750, it was 55,200.